We have Priyankar Biswas, who's the India analyst tracking industrials, logistics, and metals at BNP Paribas, joining us. Uh, and of course, talk of town right now, Priyankar, because a lower Capex announced has resulted in reactions across the board on industrial counters. What do you make of both the budget as well as the reaction?
Yes, thanks for having me on this show.
It's good having you,
Uh,
Priyankar.
Thanks. So what I can tell you is that the main disappointment was that the relative flat growth in the capex for this year, number one, that is the FY25 RE versus the FY25 BE. So there was clearly a miss. And the growth that is coming in next year is actually quite a bit of spillage from this year to the next year. So there has been significant underperformance, especially in FY25 in key areas like defense, affordable housing, water. So while we are seeing some positive growth in this FY25 RE, the point has to be seen that it's again a spillages that is happening from the last year budget. So we cannot have that much of a clarity whether these things will eventually translate out. So that's on the problem side of the things. But the positive part is, and we had highlighted earlier in our thematic report in late November as well, that there would be a transition of the capex. So it's essentially moving from one pocket to the other. So in power transmission and distribution, then metros, airports, and shipping. So that is where the transition is taking place. And if you see that, the spends on these segments have actually beaten the estimates in FY25 RE. And in FY26, we are having even more top of growth on that. And there has been reduction in duties on electrical steel, for instance, which should also support, let's say, the transmission capex going forward. So we are quite constructive on plays, especially on, let's say, transmission, metros, and those side of the areas. So we would be, let's say, relatively constructive on a name like L&T, for instance, though it has kind of fallen today, but given that it is taken as a bellwether for the capex. But what we feel is its exposure to those slow moving spaces are quite low, and the exposure to the significant growth places like like transmission metros are quite high. So I would have my pick on that side.
Okay, Priyankar, good morning, good afternoon, rather, Neeraj here. The Madhukela today, this afternoon, morning rather, was making this point that while it's 11 odd% growth that has come into the numbers, if you add the grants that the government, the central is giving to the state government for some of the capex as well, the actual number could be much higher. Now, my question to you is, independent of what those individual views are, at what valuations, or how does the valuation cycle derate relative to what it would have been 12 months ago for you? If you were comfortable giving a valuation of X to an ABB, Siemens, Thermax, what have you, how lower down are you bringing down those valuation multiples?
So see, a very interesting point. So what we are all aware is that there has been a significant post-COVID re-rating that goes without any doubt. So we have to see how much has the re-ratings has been by each individual stocks and what have they come off today. So if I, let's say, compare to, let's say, a pre-COVID averages, so where we stand, so there is still some scope of de-rating in a lot of segments, even from here. But again, we have to see it on a relative basis because compared to, let's say, pre-COVID levels, the ROE and the margins have significantly improved than what it was then. So maybe it is unlikely that it will come back to the multiples that we had seen in the pre-COVID levels. Maybe a post-COVID average should be one that we can look at. And in certain cases, I do see quite a few of the names actually be quite close to those points with the valuations after today's fall.
Okay, so is there a pocket or a preference here outside of L&T that you have, Priyankar? And sorry for getting that name wrong first off.
That's so one can see outside of L&T, what I will say is, like, let's say if we look at the names which are exposed to transmission, for example, power transmission, where we are having, let's say, significant uptick in the capex, for instance. So you have names like a KEC, for instance. So of course there may be some corrections there as well, but we could be appearing in a good value zone later on. Then you will have something like a Siemens as well, who's like good, almost close to a 40-45% of their EBIT comes from the energy segment, which deals with the high voltage transmission. So I would say those are the names that should be relatively well off than the other spaces.
Got it. Got it. Priyankar, therefore, the question is, there are fundamentally some of the business, L&T is the largest point contributor on the losing side today, was down about 4% in Friday's session as well. I was looking at your note, and I think the note seems to suggest that L&T does not have very large presence in the spaces where the expenditure has been brought down. If anything, in nuclear, it's got a very large market share. In metros, etc., it's got a decent market share. Could it be that L&T is, like, as they say, Begani Shadi Mein Abdullah Divana, the opposite, right? It's getting clubbed with everything for the wrong reasons. And would you use these dips if you were investing? Or are you telling your clients to use these dips in L&T to buy into that stock, for example?
So yes, that's exactly the point. So there has been a lot of negativity about L&T in the past 2 quarters, let me say. So first thing that was there, it was like almost taken like L&T will certainly miss its order inflow guidance. So that we heard in 2Q, then again with 3Q. But if we look at what exactly the numbers that they delivered, I don't think anyone would be building in that they would miss the order inflow guidance, given that they are already well placed on 500 billion of tenders as we speak. So there won't be a miss in the numbers so as to say on this year's order inflows. Now, of course, the thing about the budget is people will look at it too, what would be from an FY26 point of view. And justifiably, L&T gets hammered because it's taken as a bellwether for the Capex story. But again, L&T's share of central government itself, like when the order inflows, if we see, is only 15%. And then whatever the other comes up, those spaces that you also mentioned from my note, those are getting very strong and is actually funded by the CPSE budgets. So don't see a lot of risk on that aspect. The multiples have, of course, come back to very much the pre-COVID levels.
Right. So Priyankar, while appreciate the view with regard to L&T, but what about some of the other pockets which had exaggerated rallies? Let me highlight a few. Maybe railways is one. After which we've seen a bit of a correction also in some of these counters. And then we've seen a flattish kind of move with regard to allocations in the budget. What would you make of that? And therefore, what's the view there?
So while we do not explicitly cover railway stocks, what I can say is that the flat railway allocation is kind of disappointing. Let me put it at that. So in real terms, it would mean probably a dip as well. So essentially, like if you see in the past, there has been a massive re-rating across the railway sector, if I have to blend it up both. So there still remains a scope for correction, is how I'll put it there. Because the key line items that are there, the budgets are practically flat, even if we look at individual items. So where will the order inflow growth come from in railways? That is very questionable.
And would you also put defense in the same breath as railways, or would that be different?
So I may just go back to my reports in November as well. So a lot of the defense rally that I had highlighted was actually driven by retail. So the proof of the point is the number of investors that are there in, let's say, the shareholders have gone up anywhere between 7x to 20x. That is what has happened in defense. So institutional buying does not push up the number of investors, it's retail buying that pushes it up, and that too in limited free floats. So that froth was always there. So that froth has, of course, come off a bit, but there is still some way to go, is how I will put it. And then the other point is the defense miss was somewhere around 6-7% versus last year. So the growth that you see optically today at around, let's say, 12-13%. So if you see, even that could be missed as well. But let's not get into that. But even from a FY25B, that growth is quite limited. So what gives us the confidence that we may not be like flattish versus FY25BE next year? So there is an issue over there as well.
Fair point. With regard to nuclear, now that's a largest kind of allocation made and a largest kind of commitment made to nuclear. So of course L&T will benefit, but along with it, would there be certain other ancillary stocks which you would want to keep your eye out on, which could well benefit from this possible multi-year tailwind, if I can call it? Just like the way 3 years back a railway, a defense were part of that tailwind, could there be other stocks as well on your radar?
So I haven't looked into nuclear in that great detail,
Okay.
like let's say what are the individual subsegments. So I am looking at it from a very broad brush, let me say. And from a EPC contractor view, when we say that L&T has a 50% share, so we were essentially referring to that aspect. So we haven't delved into the ancillaries, to be fair.